Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience of SmithWeekly, including John Q., Eamon M. at Hemesh40, Ben H. at Victor079-61508, Matt B., Cyril O., Chris T., Sandro C., at DasHa5, Barry G., and Harry C. New guest on the program today, John Ciampaglia has joined us. John is the Chief Executive Officer at Sprott Asset Management and Senior Managing Director of Sprott Inc. Sprott has a number of investment vehicles, including the new Sprott Physical Uranium Trust. You can learn more at their website, sprott.com/uranium. The Physical Uranium Fund is listed on the Toronto Stock Exchange under the symbol U.UN in Canadian dollars, U.U in US dollars, and also on the US OTC markets under the symbol SRUUF. John, welcome to the program. How are you, sir?
Great. Thank you for having me. Appreciate it. Trying to finally enjoy summer. And I think a lot of market participants are doing the same. So we're in summer doldrums, but I think well-deserved for most people.
I think you've been busy running the airwaves on the new trust. And of course, the gold is bumpy. Uranium is stagnant at the moment. And hey, we wouldn't have it another way. So exciting to see what happens in the fall here. Well, John, we have a lot of ground to cover with questions, and I want to cut right to it. And apologies to the audience if we didn't get to your question. But first off, can you just give us a quick update as the current status on purchasing and also raising capital?
Sure. Well, it's only been a few weeks now since the new Uranium Trust became live on the TSX, July 19th to be exact. So I would say we're still kind of seasoning the fund and getting the trading volumes pick up as many of the broker dealers have now made the conversion on their ends in terms of their records. And we're pretty excited to have this as a new addition to our suite of physical metal funds. People, I think, know Sprott pretty well for our presence in the precious metals category, where we have a number of physical gold, silver, platinum, and palladium funds. And we think the Uranium Trust is the perfect addition and very well timed for what we think is the emerging new bull market that's forming in uranium. So the fund is alive and kicking. We did the reorganization from Uranium Participation Corp. The shareholder response to our transaction was overwhelmingly positive, with 99.2% of investors voting in favor of the transaction. So I think that speaks volumes in terms of the marketplace reaction to our involvement. I think a lot of market participants are very excited to see Sprott enter the physical uranium category, given the breadth and depth of our reach with all things related to commodities. I think one of the things that's been really surprising to us is how much interest there's been in the new trust from different investors of all types and right around the world. And also how many precious metals investors have been interested in uranium as well. I think there's some commonalities between the two categories. They tend to be somewhat contrarian. They're obviously both commodities, and they both represent a lot of value to a lot of people in terms of their current pricing in the marketplace versus where people think the pricing should be over time. So we're pretty excited about having the new trust finally, after a very long courtship, on our shelf.
John, that sounds good. I appreciate that. Interesting times here. I just want to slide in here with one other thing on this kind of broad topic. You know, with the broad general market where it is today, some people calling it substantially overvalued here. How do you think this uranium thesis plays out as far as the timing with broad market? Do you think that there's a 2001 type scenario with commodities starting to rise while the broad markets come down, a sell-off across the board like a 2008 type scenario, given that we're late stages in the broad market but early stages with uranium? How do you think that this plays out?
Sure. Well, the investors that I've spoken to personally, and many of them I would categorize as very knowledgeable, sophisticated institutions and family offices. They've been attracted to uranium, and I don't mean just in the last few months, but in the last 2 to 3 years, because as you said, in a market environment where just about every asset class is trading at all-time record highs or record high valuations, there are some investors out there, believe it or not, that still exist that are somewhat value oriented, even though value's been the tougher of the two market approaches of late. But there are still investors that are value oriented and contrarian, and they're looking for pockets of value in what they see overall as a very inflated market, whether those are equities in general or obviously different parts of the credit market. So in an environment of endless money printing and central bank support and fiscal stimulus, valuations are stretched on many things. If you look at something like physical uranium and the uranium stocks, I mean, this category has had a miserable time for about the last 10 years, really starting from Fukushima in 2011, very long protracted bear market. And the sector's gone through a very tough and agonizing reset that we think is behind, and now the market is starting to build a new base and starting to set itself up for what we think is a new bull run. So we're definitely seeing interested investors that are looking for value, looking for kind of a contrarian trade when there are a lot of crowded trades in other categories. So I think that's very interesting. The marketplace on the uranium side is clearly out of balance, meaning that the supply that's currently coming online is not there to meet the annual needs of the fleet of reactors worldwide. So the uranium producers have become much more disciplined in terms of shutting in production. Clearly, the uranium companies do not want to have all this production shut in because it is expensive to put mines on care and maintenance, but it's obviously more costly to mine something where you're not making a sufficient return on your invested capital. So there's a lot of idle supply out there. It's not going to come back to, it's not going to come into the market unless there is an incentive price to do so. That's the feedback we've gotten from a lot of the different uranium producers. So I think the market is going through this supply demand, reset or trying to rebalance itself to find a new level of equilibrium. Sooner or later, the secondary supplies and stockpiles run down, and the market's going to be forced to come in and to reload their inventory. So we think the headwinds that the uranium market has faced for much of the last 10 years are starting to turn into tailwinds, and that's really why we got involved with this transaction and spend the better part of 2 years working on this this particular transaction.
Appreciate that. Well, let's dive in here because I've got a lot of stuff to talk about on some of the things you just skimmed on here. First off, any purchasing goals that you want to state to be achieved by the end of the year?
Well, it's really a function of the market. If there's market demand for the trust will have the ability to grow and issue new units. It's something we've done very successfully with our gold and silver closed-end funds, where we've implemented something called an at-the-market offering, and we run this program for all of our closed-end funds, which basically allow the funds to issue new units on a non-dilutive basis to the marketplace when there are periods of demand or market interest. And we find it's a very effective way to grow the fund. One of our primary objectives is to make the fund larger, to make the fund more liquid. And the reason for that, obviously, is self-evident in terms of the financial interest we have. But I think more importantly, it will allow the marketplace to evolve, attract larger institutions who want to get involved in the space, but really don't have a lot of options to do that, or the options they have are not necessarily something they're comfortable with doing. So we think the trust is a really good vehicle to scale and to size and provide liquidity to market participants as the interest in the trade broadens. We don't have any specific targets in mind, other than we want to grow the trust by multiples of where it is today. The fund is still quite small at about $630 million in size. And I say that, I'm not trying to be too cheeky, but it is small when you compare it to other commodity stockpiling funds in the marketplace. And I think that's just a reflection of where we are in the cycle. It hasn't attracted a lot of capital other than the last 6 or so months, where you have finally seen a flurry of activity of buying interest. And those are all really good signs and evidence that the cycle has turned, and a broad range of investors are getting involved in the uranium market again.
Well, John, so let's make a goal for first quarter 2022 to see that round off at about $1 billion. Let's get there. Well, let's move on here for a moment. Does it matter to you, John, and for those who understand the full details of this current market situation, that you buy uranium at, say, $18, $24, $30, or even $35? Other than being cheap, are you just splitting hairs at this point, given that I hope the Sprott team fully understands that this market must go to incentive price and likely beyond that? Therefore, it doesn't matter if you buy it at 32, 35, because we know where it's headed.
Well, at the end of the day, the way the program works is we raise capital and we put that capital to work as quickly as possible. One of our primary objectives with the trust is to be at least 90% invested at all times, but our true goal is to be closer to 100% invested at all times. So we want to raise capital and we want to put that money to work as soon as possible. We want to minimize any tracking error in the fund and any cash drag. So, we will basically buy at the spot price. That's really our goal, is to buy at that spot price. And if the spot price drifts higher, then we're forced to buy at that higher price. So we hope that the fund will act as a catalyst to provide more spot market activity, more spot market price discovery, and transparency. I think that's one of the pieces of feedback I've gotten from a lot of market participants, everything from investors right through to producers, is that they would like more activity, more frequent activity in the spot market to help facilitate true price discovery. Now, we can't control that ourselves. It takes investors to give us capital and contribute to that cause. But if there is investor interest, we will put that capital to work irrespective of where spot pricing is. We will ensure the fund is invested at all times. So, and your point about incentive pricing, you will see different research reports forecasting where they think incentive pricing is. I've seen everything from ranging from $50 to $60 a pound, and just this week, U3O8 dipped down to about $31. So it's been quiet the last couple of weeks in the market. I think that's just normal summer, August doldrums. I do expect that market activity will perk up as we get into the fall and the capital raising activity of the trust commences.
Come back for a moment here. You guys were working on this deal for a while. When did this start? What was the idea? Who sparked the idea of saying, this is a good time to start looking at taking UPC, we can make it better? Talk about what people were involved, and just talk about that initial process as to why you guys thought it made sense to start out and go after UPC.
Sure. Well, I think it really started back in 2017 when we made an announcement that we were acquiring the Central Fund of Canada, and there were a lot of parallels. Central Fund of Canada was one of the oldest gold and silver funds in North America. At the time, it was about $4 billion in size, and we did a friendly acquisition to acquire that. We announced that in late 2017 and closed that in 2018. And we thought, with that particular fund, we thought there were a number of things we could do to enhance it, to make it more marketable, to make it more shareholder friendly, to give it more prominence in the marketplace. I think we had a lot of success in doing that, in terms of taking a fund that was traded historically at a very deep discount to net asset value and reinvigorating it. So we'd gone through this playbook once before, and with UPC, it was created way back in 2005, but Sprott was somewhat involved with its creation and its support in the early days. So there was a long history, and we thought, here's a fund that could use some it could be re-energized, and we thought it's the sector is really washed out right now, and what would be a great time to kind of get behind this and give it a boost when we think the cycle is about to turn. And that was just over 2.5 years ago. And I think a lot of uranium investors have told me the same thing, which is, we were a bit early. We started building positions in 18, 19, questioned ourselves a lot, but they're feeling very good about where they are right now. So we had similar views of there was value there. There was an opportunity for the market to reset. Uranium prices were just abnormally low, and why would anybody want to sell uranium at such deflated prices back in 2018 and 2019? And we went through a process of determining, should we start a new fund from scratch? Should we buy a fund? And I think we concluded pretty quickly that buying an existing fund that happened to be the first of its kind back in 2005 would give us a huge leg up in the market in terms of startup. It took us a while to get the transaction done. The UPC board wanted to make sure that they were entrusting their shareholders to the right manager. And I think we put together the right transaction in terms of financial consideration and all the other consideration that Sprott brings to the table in terms of its network, its reach, and its resources to really promote the fund and to scale it and provide investors with more liquidity over time. So, I'm happy we did it. At the time, it felt like forever, but I think the market response we've gotten so far has made it worthwhile so far, and we're just getting out of the batter's box. So we're happy that we were able to do it, and the market response has been great.
Well, John, I hope the UPC board was delighted with you guys coming to the table. I think it was a good move on their part here. And I understand that Sprott is planning to be very aggressive in providing price discovery in the spot market. And the Sprott vehicle is not just here to collect some management fees. Give us some figures if you can, or maybe just talk to your level of aggression, because I assume this will not be like the former UPC or a vehicle like Yellowcake, which have both been too passive in my view, and in the case of maybe Yellowcake here, a little bit too fat in regards to G&A. So, what's your guys' level of commitment towards aggression and making real price discovery?
Well, I think it really starts with offering something in the marketplace that is shareholder centric. And what I mean by that is everything from your product design to the product features. These were all key variables that the UPC really dissected to make sure that the transaction made sense for everybody. So I'll start with the investment structure itself. I think that's really important. UPC and Yellowcake are both corporate structures. They're commodity stockpiling companies or holding companies. And what we have done is reorganize UPC into an investment fund or an investment trust. And it's important for a few reasons. One, the investment fund structure is probably the most prominent investment structure for just about every investor type in the world today. When you think about all the ETFs and closed-end funds that trade on exchange today, I mean, there's about $8 trillion of these things right now. It really has become the go-to vehicle in terms of transparency, intraday liquidity, and so on. The trust structure provides a lot of really good governance for shareholders. You can't, in terms of governance and G&A, you can't just arbitrarily raise your fees without shareholder approval. So there's a lot of basic shareholder protections within the trust declaration, which is very shareholder friendly. Second of all, what we've done is we've moved to daily disclosure of all of our holdings, as well as the valuation of those holdings. And I think this is a really material development in the uranium market. If I contrast that to UPC and Yellowcake, they disclose these elements once a month. And I think for the market to get bigger and to mature, you need to provide investors with more information. So disclosure and transparency are very important to us. We think they will facilitate more evolution in the market and also encourage more market participants to get involved. Uranium is not the easiest market to understand. It's not like you can just open up your browser and get a price every 10 seconds on your screen from any news service or pricing service. Most of the uranium pricing is a paid service. So for the average investor, how do they even know what uranium is trading for today per pound? So then how do you know how the underlying investment you want to make is trading relative to the value of the spot market? It's really hard. So we've taken all that out of the equation. We're providing every night, we show you how many pounds that we own of material, how much cash we have, and we calculate a net asset value per unit. Investors can compare that against the closing market price to see exactly how the shares are trading, whether they're cheap or rich relative to underlying spot value. I think that is really helpful. I think that will help the fund trade better in terms of its market price relative to its net asset value. A lot of investors that we've spoken to over the years want market price and net asset value to be more tightly tethered together, and I think that helps. Some of the other little things that we did, we now are offering the fund in US dollars, so you can purchase in Canadian or US dollars. We've also changed the financial reporting to all US dollars. Again, why do we do these things? Well, it's a US dollar driven market in commodities. Many of the investors we have are US based, so put everything into a currency they're comfortable with. The at the market offering, I think, is another important development in terms of that price discovery mechanism. And then the last thing we committed to as part of the transaction was to pursue a US listing on the New York Stock Exchange. And that's something that is the next phase of this transaction for us. Over the next couple of months, we'll be working with the New York Stock Exchange to ready our listing application. And the reason we're able to do this, and UPC was not, was it comes down to that first thing I mentioned around investment structure. Corporate issuers cannot apply to a US exchange to be a commodity stockpiling fund. Only investment funds can. So this reorganization from a corporate structure to the investment fund structure was really the key step that will pave the road to this US listing application. So it will take a number of months to work through the SEC. It will be considered a novel listing, so it's never been done before in the United States, but we're very committed to this. And also, Sprott will be footing the bill for this. And that was another key element of the transaction consideration. Sprott will be paying all the legal fees related to the US application.
John, let's talk about that for a moment here on the US listing. When do you really realistically see this happening? I'm assuming sometime maybe Q1 2022. And also, given the existing network at Sprott, do you guys see any hurdles that may trip this up?
The SEC, it's impossible to know how long they will take and how they will react to the listing application, because they won't give you feedback until you actually formally start the process. So we have gone through this listing process for commodity stockpiling funds 5 different times. So we're well accustomed to it. We have great lawyers that help us through it. The New York Stock Exchange is very important in the process because they actually make the listing application to the SEC on our behalf. So we've gone through it many times. The process can take as little as 4 months, but that's for that's for listings that are not considered novel. This, as I said, would be considered novel because it's never been done before. So we think it's going to take a little longer than the 4 months. So it's impossible to know until we get into the process with the SEC. But it is most likely a Q1 2022 type of timeline. We don't think there's going to be any real hurdles. The reality is the TSX listed units that we have today, we're able to offer most investors access to that. And so I don't want to belittle the fact that we're just on the TSX right now. Having the New York Stock Exchange listing, I think, will really open up the door to more liquidity, more institutional interest and whatnot. So we do think it will be very important for the trust to be duly listed, as all of our other trusts are. So it's really about the unknowns right now, because no one has really gone through the process with the SEC. And that's always something that you have to kind of take step by step, day to day.
John, is it pretty much novel in the sense that we want to start a baseball card stacking fund, or we want to stockpile Coca-Cola or chocolate? Is that what you mean by novel?
Yeah, so when I say novel, it just basically refers to the fact that the SEC has not approved a similar vehicle. And so we know that there are lots of commodity stockpiling funds in the US that are related to all of the precious metals, for example. We know that about 10 years ago, there were applications made for physical copper funds, which in the end, the SEC did approve. The sponsors ultimately decided not to launch them because the commodity cycle had turned. But, you know, going back 10 years or so, the copper trusts that were filed were at that time novel listings. And they did take a little longer to get approved than your established gold and silver funds, but in the end they did get approved. You know, it was ultimately the sponsors that decided not to proceed with them. So we looked at those copper trusts as potential precedents, albeit they are kind of old now in terms of when they work through the regulatory process. But you know, in the end, I think the SEC, their process is very solid in terms of ensuring that vehicles are approved on the exchange that provide investors with a very high level of transparency and protection, and that, you know, there is clearly a liquid and transparent market underlying these values so that investors are making informed decisions. So, you know, it takes a little longer, but I think in the end you get a better result.
Yeah, and I think, you know, the TSX listing works well. And then, of course, you guys already have New York listed other precious metal funds. So that's also in your favor there. So it all sounds pretty positive here. It's just a matter of, I think, jumping through the hoops, John. I want to go back for a moment and talk on something you said earlier. And I want to go back and maybe just pick on Yellowcake here for a moment. You know, my understanding is they did not exercise their 2020 option due to net asset value. Splitting hairs again, John, in my opinion, based on the current price of uranium now and then. If you guys are at a net asset value break even or maybe even a little negative, does that influence your decisions to buy uranium when the price is right?
Yeah, so the number one condition we have to satisfy is not issuing new units at a price lower than the prior day NAV. And this is a fundamental shareholder protection because essentially what it does is it doesn't allow the sponsor of the fund to issue new units on a dilutive basis. And that's really important. That really keeps the integrity and credibility of your fund intact. So we will have to ensure that everything we do is accretive to the fund on that basis. So as long as we've got some premium to work with to net asset value, we'll be active in the marketplace. And I think the one benefit of the ATM versus the prior history of, say, UPC, I like to call it the stars must align scenario, where you need to have a lot of interest in the underlying asset. You need to have enough premium in order to pay the different fees related to a transaction. You then raise the capital and tell the market you're going to go and buy a big chunk of material. And then what happens inevitably is you go kind of dark for a period of time. It could be months, it could be a year. And, you know, it's great. You grew your fund. That was the right thing to do, but it kind of goes into a sleep mode. And we think it's important to be more active on a more frequent basis and just kind of chip away at the market, raise capital in smaller dollar amounts, but more frequently to keep that kind of spot market activity going and to accumulate pounds more frequently. I think that's the scenario that we think will serve investors best. And it's the scenario a lot of investors have said to me, you know, that's what we want the trust to do. We want the trust to not raise a bunch of money and then go into sleep mode. We want it to be more of an active, ongoing and consistent participant in the marketplace.
Let's switch gears for a moment, John. Do you believe that the global existing mine capacity, both producing and those that are on care and maintenance, can sustain the fuel demands of utilities going forward? Or do you have another position that the bulk of the development projects that are in the pipeline must be brought to mine reality, of course, at incentive price or above, to serve future consumption?
Yeah, that's a great question. So there's a lot of shut-in capacity, as you referenced. That capacity can come back online within a reasonable amount of time. Those are the easy to get pounds, and hopefully those pounds coming back online at the right price will help keep the market in balance. The reality is that all reserves are depleted daily, and any kind of commodity in the mining space needs to invest and finance new exploration and development, because as you know, the lead times on these projects is not getting any shorter. It is not uncommon to see a project go through a 10-year cycle from initial drilling and discovery to financing and development, and then obviously there's a ton of permitting and social contracting and everything in between, and all things ESG. So the lead times are enormous. So the shut-in production obviously is your first line of defense to meet demand, but even those producers need to constantly find new reserves, and sometimes those new reserves are obviously not the same cost points and cost curves. So that may require higher incentive pricing for them to come on board. I think the bigger picture idea here is this bear market that we've gone through for most of the last 10 years has really resized the market. A lot of uranium companies have come and gone. The capital that's gone into the discovery and development of new assets has been very muted. And whenever you see that happen, there is a risk of supply disruption or potential shortages, unless there's an incentive for companies to spend the money. And let's face it, a lot of capital has not been, other than the last, say, 6 or 9 months, a lot of capital has not come into the sector for many years as investors have been focused on other areas. So it's important for the entire industry to have the right financial incentives to keep the industry healthy. And you know, the utilities obviously consume the uranium and they need to replenish it. I don't think it's in their best interest to have a uranium price that is too low for the producers, because the industry will basically shrink and die over time if the incentive isn't there to keep exploring and to keep developing these projects and bringing existing mines back online. So I don't know what that magical, you know, equilibrium price is, but you know, clearly there are a lot of mines that are shut in right now, and the producers have been very disciplined in terms of saying we're not bringing these pounds back online unless we see a higher price. So something's got to give. If it doesn't give, then you've got a bigger problem to deal with.
I think that the lead time's underestimated. The lead time from a capital decision, also the investment that needs to go into that. What's the lead time from that decision point to raise capital and then start a project construction or a restart? Certainly McArthur River, for example, is probably an 18-month exercise to get things up and going and maybe not even fully ramped at that point. Then you tie that in with the contracting cycle, the term contracting cycle that is certainly before us over the next few years that will have to start, especially if you're a U.S. utility, probably has to start within the next 2 years. It's a great setup to where we have all these convergence of factors. And then, of course, as you said, the social license, the ESG component, environmental component, as far as getting these projects permitted. It's difficult to permit a project anywhere in the world now, let alone Canada or the U.S. or, you know, places like Spain, for example. So, and then there's a chance the projects never get permitted. Another one here for you, and it's probably a good chance that certain parties in this market at some point probably ask you not to make purchases, possibly a utility or an agent of a utility. What's the Sprott response if this comes about? And do you guys plan to have any relationships in the market in that way, or is Sprott's determination for the unit holders first and foremost, and is full-on competition in the spot market?
Well, yeah. I mean, the utilities obviously would like to see prices stay as low as they can be for as long as they can be, but you know, I think my position was that's not sustainable. So you are really running risk of supply. Maybe not this year or next year, but longer term, they do run the risk that the security of supply will not be there. So I don't think that's sustainable. At the end of the day, I think this fund, if the way I'm thinking about it is, this fund is really another utility in terms of a buyer in the market for material. The difference is, with a utility, they buy material, it has a life in the reactor, and then it gets stored away as waste. With the trust, it obviously is stockpiling material and not consuming it, not selling it back into the marketplace. So that's the key difference there. But yeah, I absolutely expect to be competing with other market participants that are interested in buying it. And obviously the largest user of uranium is the fleet of reactors. So yes, I'm sure there will be some competition for material. We will be, I guess, operating in a different segment of the market. We're not looking to buy material with, many years in the future delivery. That's not something we're interested in doing. And that's obviously the preferred contracting route that the utilities take. We would like to take more near-term delivery. And, in sharp contrast to some other markets, near-term delivery in the uranium market is not the same. Meaning, like when we buy gold and silver, I expect to have the gold in my vault in maybe 2 weeks. And depending on where the silver is coming from around the world, the silver might take 3 or 4 weeks, or maybe 6 weeks if I have to ship it from London. And the uranium market, near-term delivery can be easily 3 months. So it's a very different definition. We expect to be buying more in the short end of the marketplace with more near-term delivery, whereas the utilities will be playing out with many months or sometimes years until they take physical delivery. They just buy differently.
John, on that topic, delivery lead times, will they establish a policy, or maybe there's a policy in place to purchase uranium for delivery within 30 days, or maybe like we've seen, those delivery lead times tend to stretch out 3 to 6 months? Do you believe that a 60 or 90-day window is a good policy? Are you guys going to be flexible? Will you have a pretty hard policy to keep this on the shorter end?
So we don't have a set policy, but all things being equal, the shorter the better in my mind. That's not always possible, but that's what we're going to strive to do. Yeah, as I said earlier, the near-term delivery definition generally in the uranium world is within 3 months, and I understand why that is. The time it takes for you to mine the material, to put it on the first set of shipment usually goes to a port, so truck to port to conversion facility. Some of those distances around the world are quite far. If you think about places like Australia or Kazakhstan, that material is going a pretty long distance to get to, say, France or United States or Canada, where the primary facilities are. So it takes time. I understand that. It's not like putting a pallet of gold on a plane and zipping it over in a day or two. But we would like to try to focus on near-term delivery if possible. That's where we're going to focus a lot of our buying activity.
Sure. Yeah, because longer lead time, obviously you could put there, you guys buy it, Cameco delivers it to you in 24 months. I mean, gets into that type of situation where a silly setup rather than forcing the hand of the market and actually deriving, spot price discovery. Let's come back here for just a moment. In the trust agreement, if memory serves me here, I believe it's section 7.2 manager duties. It specifies the use of industry standard tenders and direct negotiations and off-market transactions to achieve best prices available. How will this policy lead to spot price discovery?
The uranium market is unlike any other commodity market what we've worked in so far, given it's a handful of producers and a handful of traders. So we've drafted the language to be pretty flexible, because the reality is we need to have optionality in terms of who we're dealing with and how we're buying that material. We obviously want to deal with participants in the spot market. But the reality is the producers control a lot of the supply. There's a handful of producers that control a lot of material. So, we need to ensure that we've got a dialogue with them in place, along with the brokers that, tend to be dealing in smaller quantities. So we've only bought a couple 100,000 pounds so far. So we're just kind of testing our process and our model, and I think it's probably fair to come back to me in a few months and ask me how the actual experience has gone once we have some more opportunity to buy.
That sounds good, John. Hope we can chat to you again here, and you'll come back after we're done with you on this chat. Given that trust can become a large liquid vehicle, especially if it achieves New York Stock Exchange listing. And as you guys appear to have a pretty ambitious strategy, John, could utilities traders or other parties use the vehicle to hedge against rising U3O8 prices in their future spot reference delivery contracts?
Yeah, I mean, it's impossible to know how the trust will be used, but I think as the fund gets seasoned, it scales and becomes more liquid. I do think it plays a potential role for different market participants. You know, there is not a liquid futures market, so there aren't many ways to gain exposure to the underlying commodity. We hope the trust will help facilitate that for sure. The other issue that we've seen is some market participants have opted to do their own direct buying and storage. Again, I hope that the vehicle will act as a very competitive alternative to that particular decision, where we've seen some junior miners and whatnot raise capital and buy pounds directly. Again, if pounds tend to concentrate to the fund, it'll make it more liquid and more useful to, I think, a greater range of market participants.
That's a very good point. And what I wanted to get to here was, is it possible? I mean, maybe you can talk about this for just a moment, but the sector is extremely fragmented, John. You know that the whole sector is. So the point being is, how do we maximize every penny towards the fund? And you just touched on that. You've got a bunch of different funds out there buying. You've got even wannabe uranium companies buying. You got producers buying to hedge maybe a future long-term contract or some kind of a bridge between production startup and commissioning. We can fill some of that gap in the meantime type stuff. Some of it's good, some of it's silliness, but can a uranium company that's a producer, a developer, etc., call you guys and purchase units? Is that a possibility? And then also with that, back to what you said, how do you guys attract and encourage the institutions, the family offices, the high net worth, and even pooled retail to go over to Sprott over buying their own pounds and storing separately of Sprott? Because it's going to be in the same warehouse, John. What's your thoughts on those items?
Yeah, no, it's a really good point. I mean, you have to. I mean, one of our ideas around this whole transaction was, what was a catalyst that forced certain market participants, and obviously it's not individual retail investor, but let's say a hedge fund. What prompted them not to buy one of the two existing vehicles that were in the market available to them, and buy their own material and have their own storage agreement? So to me, there's something there. So I contrast that to, let's say, the precious metals markets, and I think there are some commonalities with when you look at the gold ETFs prior to the creation of the first gold ETF. Owning gold was a cumbersome, expensive process, complicated, and really what these ETFs provided the marketplace was convenience and simplicity and liquidity. And I think those are some of the objectives that we're trying to meet here. You shouldn't have an incentive to go and buy your own material and to store it yourselves if you've got a competitive, liquid, transparent alternative available to you. And I'm hoping that some of those institutions might say, well, it doesn't make sense anymore for me to buy my own material. Why not take advantage of the scale and the cost efficiencies that Sprott is able to offer, and why wouldn't I put my dollars to work inside a vehicle that's easier to buy, sell, and to own through? So that is one of our goals. We are starting those dialogues with different parties around that, and I hope we do see some interest in terms of that behavior, because I have had institutions say to me that we have not bought the prior vehicles for reason 1, 2, 3, and which I always find kind of interesting, because it's not like this is an easy category to get invested in. And so if the marketplace was not completely happy with the existing vehicles, it's a good sign that the market was ready for some evolution.
Yeah, John, I mean, I'd like to see your man at the warehouse with the Sprott stickers, throwing stickers on the existing barrels and transitioning all those mixed ownerships into the Sprott vehicle here. And then also you guys becoming a potential vehicle for the companies who want to buy, the listed companies who want to buy uranium, as we saw earlier this year. And then, like you said, you guys would be much better. You guys have better leverage with your networking relationships than a lot of these groups do. So why not go through Sprott? I think it makes sense, and I hope you guys, attack those various parties and have a discussion about that. It brings me to the exit strategy for this vehicle. I've come up with, of course, some means and methods established for this that we think is viable. And of course, we've written this into our next letter upcoming for members at the end of the month. But can you talk about the exit strategy for this fund when the time comes to sell down holdings? What's your thought on exit strategy? I know there's a lot of different ways we could do this.
Yeah, so it's a good question. I get asked this all the time from investors and producers, quite honestly, that are interested. Is this vehicle, given we have a very large stockpile right now of about 19 million equivalent pounds of U3O8, is this vehicle going to be selling material into the marketplace from time to time? And obviously there's sensitivities around that, particularly when there might be some softness in the market, which could further, compound a downdraft in the marketplace. And my answer is pretty simple. Our intention is not to sell pounds back into the marketplace. It's important to keep the fund scaled and liquid, and selling pounds in the market during those pockets of softness, I find, does not have a meaningful or lasting impact on what you're trying to do. So our intention is not to sell any pounds back in the marketplace. We will manage the cash in the fund to pay the expenses. And we've done a pretty good job of doing that with our other trusts, where we basically never sell any metal. So that's the goal. And I think a lot of participants are relieved because they don't want the fund to be viewed as this secondary supply overhanging the market that could hit the market and really push the price down like it did a few years back.
Very well, John. And I know there's a lot of other ways we could look at this too. And then, who knows what your opinion may be when uranium price is at $90 a pound, if it gets there. How you guys monetize and how that works. And of course, liquidity in the spot market at that time, what that's going to look like, obviously much different than it is today. And then term contracting, the trader relationships out there, there's a lot of different thoughts that I have on it, but we'll save some of those thoughts for now. If institutionals take up large positions in the trust using the proposed ATM program, what will be the unit redemption options? Will the trust have to sell its uranium holdings for redemptions, or is it just a matter of taking off the Sprott sticker and putting on the client sticker who redeemed it at the same warehouse? Major selling pressure. You said you're not going to sell into a soft market. Obviously, the trust could then trade at a discount to NAV for some time. How are you guys going to handle that?
Good questions. So right now, the trust does not have a redemption feature. And this is a key difference with some of our other products. Gold and silver, if you want to do physical redemption with us, obviously we can accommodate that through armored car service and deliver you those metals anywhere in the world. Obviously with uranium being probably one of the most controlled elements in the world, not so simple. You just can't ask for delivery of uranium. So at this time, we do not have any physical redemption feature or cash redemption feature available on the trust for those reasons. So the ATM, just to kind of go back a step, is really there to meet pockets of market demand and buying interest. It does not work the other way, where we will buy your units back and sell the material in the open market.
Okay, John, so let's have a scenario here where, let's say ABC Uranium Producer Co. buys units, a block of units from you guys, and let's say they want their uranium that they bought redeemed in the same warehouse, for example, so it's just taking off the Sprott sticker, sticking on their sticker, the material doesn't move, but they need to take that material and then fulfill some type of a trader obligation or some type of a contract. Is that possible? Is that a consideration?
Yeah, no, at this time that is not possible. They would have to sell their units in the open market, and obviously they would get exposure to the uranium while they're holding those units if they were, using the trust as a way to park cash or to gain exposure without having to do the physical procurement and storage themselves. So they would have to sell their units. Another investor would have to buy them. They would have cash, and they would be hedged along the way in terms of whatever the uranium price was along the way. They would have exposure to that. But now at this point, we're not doing any redemption options.
Okay, that sounds good. And with the current volumes, speak into how you guys are going to issue the shares here. My suspicion is it's just simply going to be flexible, John, and you guys are going to be careful about how you issue the units, but not really any concerns with impacting price as far as, you guys just matching the day-by-day condition and not dropping a lot of ATM shares at one time, which would impact price. Is that basically you guys are going to adjust by volume?
Yeah, that's a really good way to describe it. The ATM process is completely controlled by us as the manager. So we decide on any given day or any given minute whether we want to engage or not with our underwriters. We control the process, which is important, and it really depends on market conditions. We don't want to crowd the market out. So we're very careful to kind of find the right balance between meeting that liquidity need and allowing existing investors to kind of sell their units in the marketplace. We've had over 5 years of experience managing these ATM programs, so we've gained a lot of practical experience, and there's nuances to it. I'm glad we have all that experience because it's not just run by computers. There's a lot of human intervention on some very busy days. It's not uncommon for me to be going back and forth with our underwriters and traders 30 or 40 times in a day, moving, checking to see where our levels are, looking at where we are relative to spot, and trying to figure out how to get material to buy. So, uranium obviously is a different market. We haven't, bought a large quantity yet, so it's going to be a kind of a wait and see approach. But the experience we've gained with the gold and silver trusts has been, I think, invaluable in terms of putting the ATM to work on the uranium side.
John, so you guys have WMC Energy as your advisor. I'm assuming that that's obviously on the front cover here, but you guys have a big network of multiple agents to act on your behalf to purchase material on the spot market. Is that correct?
Sure, yeah. So WMC Energy, we've hired them to be a technical advisor to us. We're really happy having them on board. They've been involved in the transaction for many months ahead of the actual closing, and preparing us and doing diligence on everything. So they've been really great to work with. They're both based in the United States, and they're both ex-Cameco employees. So they've got lots of experience at one of the largest uranium miners in the world. Really what we're using them for is to advise us as the manager on all things related to buying uranium and storing uranium, trading uranium. So we're leveraging their network of relationships and different trading agreements that they have set in place. And they're also acting as, intelligence in terms of market activity, subject matter expertise for help with different marketing. We have put them in touch with a few institutions so far that want to, do a deeper dive in the market, or are still doing research on the category before making commitments. So they've been very helpful. They're very knowledgeable, and they've already added a lot of value to the trust.
John, I appreciate that. And getting closer here, I just got a few more questions left. I appreciate you sticking with us here. A lot of good subject matter. A couple things on the projection models that UPC has, and of course, Yellow Cake puts out. Will you guys continue to talk about some of the bigger market fundamentals and put out those different projection models of, uncovered requirements, et cetera? Additional services, will the trust continue to put out that research?
Yeah, absolutely. Education is really important to us, not just for uranium, but for all the categories we compete in. We think that investor education is really the starting process to getting any investor interested in any of our funds. So we expect to be even more active than we are in the precious metals sector, because I just think the uranium market is still not well understood. It's still largely dominated by much more sophisticated investors who have been watching the market very closely for the last few years. If the market interest broadens out to more, let's call it different advice channels, intermediaries, and do-it-yourself investors, that's when I think you really see a market take off. And as I said, if that investor base has trouble even finding out what the spot price of uranium is every day, how do you expect them to even get invested or interested in a category? So we're going to be doing a lot of education, content marketing. Our plan will be to do, webcasts and put out different content pieces on the marketplace, one-on-one education and calls with potential investors. So yeah, we definitely think there's a big need in the marketplace.
John, any comment on the thickness, if you will, of this spot market for a moment? And then also, let me couple that with just getting your thoughts on secondary supply. And obviously, you guys are over the next 6 to 8 months here, you guys are even shorter, are going to get a pretty good idea of how thick this market really is, and if secondary supply is having a substantial impact at this point, or if that's greatly reduced.
You know, the spot market, I think, is a direct function of the market participants. And you know, the primary buyers, being the utilities, have opted for the most part not to play in the spot market. So in the absence of the largest natural consumer, who's been in the marketplace to help the spot market evolve? And I think the answer is not enough players or not enough of any size. And I think that's the potential role for the trust to play, is that if there is investor interest and capital raising, that's where we intend to be the most active. So that's the part of the market which I think the trust will be most visible within. So right now, the answer is the spot market is not very active, and it's not very liquid, and it is not a lot of material for sale on any given day, because the market has not been conditioned to meet day-to-day interest there. I'm hoping to change that over time.
Well, John, if anybody's going to change that a little bit, it'll be Sprott, because they know everything there is to know about buying illiquid junior mining companies. How about the broad nuclear energy stage adoption from Sprott's perspective, or from your perspective? Are you guys seeing that adoption start to change, and the promotion of nuclear starting to change, the stance on nuclear starting to change? And then also, what do you think needs to happen from a policy and awareness standpoint in places like the EU, the UK, and the US, and those types of areas that are, a little bit on the fence about nuclear?
We think that narrative is already begun to change, and the policies clearly started to change. And I think that's what's really exciting about it. I think uranium and nuclear has this stigma attached to it because of past accidents and nuclear weapons. And obviously, those were very unfortunate events, and very difficult lessons were learned as a result. But in reality, nuclear is very safe compared to other forms of energy, is incredibly dense, and is very reliable. And when we look at these decarbonization goals that are being set around the world, if you look at the electric vehicle goals that are being set around the world, there's just no way that nuclear does not have a role to play in that. Yes, solar and wind are going to continue to get preferential treatment by many governments and subsidization, but the reality is they just don't provide enough stable baseload power, and nuclear has to play that role. I think what's happening in China is really meaningful in terms of their evolution away from coal as a primary means to generate electricity and migrating to nuclear. I mean, they're at the forefront here in terms of this transition from very dirty carbon to very low carbon intensity nuclear. So we think the narrative's changed. The Biden administration's recent announcement that's supporting nuclear in the infrastructure bill is very positive. The recent EU taxonomy on nuclear being part of a safe energy mix, I think, is very positive. The Europeans obviously are way ahead of the North Americans on electric vehicles, but you saw the Biden administration set goals today or recently on 50% targets electric vehicles in the future. All of these things require more power, more electrification. We think nuclear and uranium are getting they're getting check marks, whereas in the past they were getting kind of X's. The other interesting thing that we see developing in the marketplace is uranium and nuclear is almost now being put into a low carbon electrification bucket, much like battery material metals are being specified as being part of this electrification push. So when we talk to investors, things like copper, lithium, cobalt, class 1 nickel, uranium, like all of these things are important elements in order for us to reduce carbon and to move away from fossil fuels and more to electrification, whether that's in transportation or whatnot. So we think the narrative has really changed around nuclear. It's getting a lot of support. Yes, there are countries like Germany that are, wholeheartedly moving away from nuclear. I think that's somewhat short-sighted. If you look at their CO2 emissions against relative to their neighbor next door at France, which 70% of their power comes from nuclear, and you look at their cost of electricity versus France, there is no comparison. So yes, people want to move away from nuclear in certain countries. Yes, some of the Japanese reactors have been much slower to restart than expected, but there's a role to play. I happen to live in a part of the world that generates most of its electricity in a low carbon format. And we're able to do that because there's 3 nuclear power plants in the province I live in Canada. We have hydro, we have solar and wind, and natural gas being the more favorable of the fossil fuel mix. So most of our electricity production here comes from fairly low carbon sources. You contrast that to other parts in the world that are still largely dependent on coal, and I'm sure it would shock most people to know that certain countries still rely very heavily on coal to produce electricity, because you think of coal and you think of something that maybe was important or very dominant maybe 100 years ago, but some countries are still very reliant on coal. And I think, net coal will be the big loser over time, and things like renewables and nuclear will be the winners.
Yeah, John, I think it's a question of energy quality, energy wealth. Obviously, that relates to the country, subject country that we may be talking about. And obviously, that varies throughout the globe. And then, I think when it comes to high class energy sources, which in my view, fission and fusion are in a class of their own, we shouldn't discriminate on high class forms of energy, which obviously fission and fusion are standalone, and nothing else comes close to those 2 items. Well, let's move on here. ESG money, popular in the market, becoming more popular in the natural resource sector. What is the plan to attract capital into the fund that may be ESG focused money?
Sure. Yeah. I mean, we've seen this profound change in the mining industry related to ESG. It's not uncommon for a mining company to do a corporate presentation, and the first few slides are all about ESG. And I think that's amazing, because we don't want the mining industry to have a target on its back like the oil industry has for the last few years. The mining industry has really responded to the need for more responsible and sustainable mining and development. And that's in their best interest, because that's how they're going to stay in business. That's how they're going to secure social licenses and permits around the world, and stay in business long term. So I think the mining companies have done a great job in terms of being responsible and sustainable, and improving their disclosure around this, which I think is really good as well. I mean, investors need to understand exactly what's being measured, what's being, through really good disclosure. So there are a number of mining companies that have done a great job. The uranium miners, they're in the same league. If they want capital and they want attract an institutional shareholder base, they have to be good stewards and mine sustainably as well. I think for the physical uranium side, I mean, yes, it has to come from sources that people are comfortable with in terms of sustainability and social license and country of origin. So those are all just table stake items now today for most institutional and high net worth investors, and increasingly for retail investors, as they want to be more green with their investments. But I think the bucket where uranium and nuclear is really going to go into is around low carbon transition. And as I said, a lot of investors are thinking about not just uranium on its own, but they're thinking of it as part of this mix of metals related to electrification. And I mentioned that suite of metals, but we think that uranium belongs in that bucket, whether it's copper, graphite, manganese, all the things that you need for electrification, for energy production, batteries, energy storage. These metals are going to be critical to this transition away from higher carbon sources of energy. So we think uranium is going to be put in that bucket. And you know, I don't want to be naive and think that all investors are going to view uranium and nuclear as green and safe, but I think the reality is that the science basically says that this is a low source of carbon and a very reliable source of power. And if the world wants to electrify, I don't see any other means of providing that base load of power without nuclear being in that mix.
Yeah, well said, John. And the outlet on your wall and my wall here don't come with the disclaimer. You have to accept the energy where this comes from. So important here, too, in terms of every subject matter at hand today is that mining is the backbone for everything. And you know this very well. And sometimes I think that people forget this in their sophistication with their iPhone, et cetera, and their electric vehicle, that when they plug into a wall at night, where does that come from? That is often forgotten in their haste of living a life, maybe being in a country that's very wealthy to where things are more accessible and easier as compared to maybe developing countries. So absolutely agreed with you. And importantly, mining is just absolutely critical to everything that we're doing, whether it's energy, whether it's climate change, whether it's technology. It's backed by mining at the end of the day. One other question here before we wrap up. You have one competitor, and that's Yellow Cake, essentially. What's the relationship with them, and how will you guys get together to collaborate to maximize the effectiveness of both vehicles toward a common goal towards value creation for unit holders?
Well, that's an interesting question. Well, I've not spoken to anybody there. We're obviously focused on our own fund and making sure it's operating well, and the marketplace understands how it works. So I don't really have any comments with respect to our competitors. I do think competition is healthy. I do think the market needs a number of vehicles to invest in. We've seen this in the precious metals markets, where there has been a proliferation of different gold and silver funds over time. And they all tend to cater to different audiences and have different features. So I do think having competitors in the marketplace is important. It keeps everybody honest and gives people choice. So I guess that would be my early comment at this point.
Well, for potential investors who are on the sidelines seeking a physical uranium vehicle, what would you say to them about the Sprott Uranium Trust at this stage and at current price levels where we are in this market, John?
Well, I think investors should have a look at the fund, and they can come to our website, sprott.com/uranium. On that page, you'll get all the information about the fund and its holdings. And I think it's all about educating yourself about what you own. You need to understand what you own and what's inside the vehicle. Transparency is really important to us, so I think we've done a good initial job of providing as much detail as possible, and over time we will provide more information. The fund is the largest fund of its kind, and I think that's important in terms of size and liquidity over time, and also the capital raising capability of that fund to provide more liquidity over time. So that's important. Fees are very competitive at 35 basis point as the management fee plus the operating expenses. And generally, if you're interested in uranium, it's a very convenient way to buy and hold it. And I think it's also a very nice complement to investors that are invested in the uranium equities. The physical is a nice complement to the equities. And we often talk to investors in the mining space where they like to take positions in the physical metals, and they also like to own the equities for greater upside potential.
And best way for interested parties to reach out to Sprott about this vehicle?
Yeah, the easiest way would be to email uranium@sprott.com. That's SPROTT.com.
John, we look forward to tracking your progress, as well as the potential for this vehicle to really bring forward the timeline for this uranium thesis. Keep up the progress. Best of luck, and stay in touch.
Great. Thank you for having me. Appreciate it.